Welcome, Bill.
Hey Todd, how are you?
I'm good. How are you?
Doing good. I've been on Zoom meetings for the most of the last 2 days, so
Are you feeling the Zoom fatigue as they've coined it?
no, it's all part of the good. It saves traveling and different things, but
Well, it's nice to see your face. We should get together in the near future when you're
yes,
not dirt biking and such.
yep.
Or,
About we're leaving tomorrow to go to an event down in Tennessee, so
oh, good, good. That's fun. What's the event?
it's a trials training center training event, so
Yeah.
bit of a ways to go, but it's worth the time to get the training. So
Yeah. What would you advise somebody interested in getting into that as a first timer? I know it's a big topic, but a starter bike or a facility to go to speak with people, or
is it? Can you be a little more? So are you talking just dirt bikes in general, or trials, or?
dirt bikes in general? Like if somebody wanted just for recreation, nothing serious.
Yeah, I think going to a motorcycle safety foundation course is a good way to start, and then knowing your limitations and starting out easy. But dirt bikes, I mean, the best way to learn is on a trials bike, but it's tough. It's frustrating, but it sure teaches the basics of balance, control, and skill, and then you can jump on and go away. But the learning curve's kind of steep. But
Is it? Yeah. We'll talk about that. Yeah.
yeah,
I could use a new hobby. So,
sure.
yeah. So you'd be the guy to talk to for sure.
Yeah, come on out, and I'll let you swing a leg over and give it a try.
Well, I don't know. I don't know if I'm ready for that. We'll see. We'll see. Well, good to see you. We'll talk soon for sure. Have a safe trip if I don't talk to you.
All right.
The weather should be nice. You're gonna miss the snowmageddon or whatever it is, right?
Yeah, that's why we're leaving a day early. So
Yeah. Well, good. Good. Is Janet joining us or just you?
yep, she's right next to me, just out of camera view.
A lot of people do that. Yeah, you don't need to show your faces. So that's the disclosure. You can be incognito, yourself included. So, but it's always good to see people. Hi, Janet. Welcome. Oh, there she is. Hello. Hey, Jenny. Hey, Laird.
Hi, Todd. How are you?
Good. How are you?
Good.
Good. I see we have Dr. Geen is with us. Hello, Ken. How are you?
Good. I had to download the app, so that's why it's taking me so long.
Oh, you normally don't need to, so I'm wondering why. That's interesting.
They probably hacked my computer.
It was actually your son who recommended this rather than Zoom. He seems to think GoToMeeting's better than Zoom for less user errors, so I'll have to tell him that you had a problem.
I'll bug him then.
Well, welcome. Good to see you.
Got a quick question. Do you have a new cell phone number?
No.
No? Because I couldn't answer your call earlier today, and it came in on a 7590 number, which I didn't recognize.
That is my desk direct line. So.
Oh, okay.
Yeah. I like to keep people on their toes, so they don't know who's calling. Right? Yeah.
Okay.
Just so everybody knows that when I call out from my desk, it comes up as, what is it, 208-4361. Is that the number that came up?
No, it was 283-7590.
Okay.
Maybe that's it. Maybe I wrote it down wrong. I don't know my own number because I don't call my desk. So, so anyway, yeah. Sorry we missed each other, but we can talk tomorrow or later on if you want to. So.
Sure. I'll text you to make sure you're not busy.
Okay.
That's your cell phone number, right?
What's that?
It's your cell phone number, right?
Yes.
Yeah.
You have that right. Yeah.
Unless you want me to call
you. Careful, Ken. I don't think I've given everybody my cell phone number, so don't put that over the airwaves here.
Okay, are you ready? I assume that's what it is.
Now that's the 344-1726 number.
I don't know. Probably so.
So, Okay, it's 2 after 4. I'll probably wait a couple more minutes. I know there's others that should be on the way. But if you don't mind, I try to be pretty much on time out of respect for everybody, but let's give it a couple more minutes before we jump in.
I don't know if you can see me in there, Todd, but Jamie's joined.
I can see you, Jamie. How are you? Is Chris with us too, or just you?
Just me.
Okay.
I've got all kinds of different numbers. None of the numbers you read off are any of the numbers I have for you. So
There's a reason for that, Jamie. I don't know. We'll see.
yeah, I just,
So for those of you who have been with me a long time, there have been a few iterations of changes with the business and numbers and things like that. So if you're like me, you never delete your contacts, or you just add in a phone number for a new contact, so you have an archive of all the old numbers. And then when you go to call somebody, you're calling the old number. So that might be part of it. But I think, Ken, you might have even had my number from the old firm before level 5. I don't know.
I've changed your number several times.
Yeah. My hope is these numbers aren't changing in the near future. So
Okay.
it's a big pain in the neck to change your numbers anyway. So, but our main line, if you ever need to speak with Tracy, she's usually the first go-to for a lot of stuff anyway, is the 719-323-1240. You can get to my desk through that, but she can connect you. But any of the other numbers you can get me as well. So, well, welcome, Jamie. You're our requisite. I think you're the only one really that's in Florida today, so that's good. We're bracing for snow here, so I bet you're not going to miss that.
yeah, I've been watching that. At my old house, they're calling for anywhere from 24 to 36 inches of snow. So yeah, I'm going to take my 12 inches of sunshine and call it good.
Well, we'll talk again in July, and we'll see how you feel.
Well, in July, I'll be in Colorado. So
That's right. It's my turn to buy lunch when you're in town.
yeah,
What? Hi. Do you want to be
we
in?
just got to listen. Right now, it's bike week here, so I've got to listen to Harleys go up and down the road. I was thinking about buying Harleys and stuff, but I don't think I'm ever going to buy one because they can't idle. I mean, the riders always have to keep just to keep them running. So they don't know how to idle. And when you get in between buildings and it kind of echoes like a canyon in there at 2 o'clock in the morning as they ride down the road, it gets a little frustrating. And we count down that there's only 4 more days till they go home. But
Well, I understand they're allowed to avoid, accidents, especially. But Harley Davidson, I think they've patented their own noise, haven't they, Bill? Bill probably knows.
I'm not a Harley guy.
Yeah.
yeah, nothing sounds like a Harley. I'll give them that. But yeah, we figured out why they have the thing of always watch out for bikers, because Bike Week teaches us that you have to watch out for the bikers because they're not watching out or obeying the rules. So you got to watch out. But that's a personal pet peeve when you suddenly get hit with 50,000 bikers overnight and they go here for a week and they leave. But
I can understand that. I tend to be a little noise sensitive myself, so I wouldn't like it for sure.
the economy is loving it. I'll give it that. I mean,
Yeah.
the Bike Week brings in a whole lot more than the Daytona 500 week does, because the bikes go out and go around and hit a lot of different bars, a lot of different restaurants and stuff like that. So the economy loves it. So for that, I'll shut up and let them ride up and down the road for a week.
Sure. Yeah. Okay. Well, welcome everybody. It's 7 after the hour. We've got quite a few here. Some people are still coming in. Good to see some of the new faces that haven't been with us before. This is our second month of trying this out, so you've seen tons of emails. I'm also testing out new technology for that, so sorry if I've overwhelmed your inbox with that. But we did our coffee chat earlier this week, and today's happy hour. We did this last month, and so for those of you that are new to this format, it's not a webinar. It's really designed just to be an opportunity to visit, to connect, to talk, and answer any questions you may have. So you have the option really to be a fly on the wall, just listen, to join in, share with us what's going on in your world or ask any questions. I always tell people that, you know, like many of you, I attend many of these similar sessions, and I'm frequently the fly on the wall because you could probably tell I'm more on the introverted side anyway. But I tend to learn more just by listening to other people's questions. So participation is not required, except for you, Jenny, because I see you smirking. I'm going to call on you. I'm just so it's really just time for you. If there aren't a lot of questions, a lot of discussion, we'll just shut it down. We're not going to force it. At the end of each month or most months, I'm trying to do more of an educational component, just that I think will be extra value for people. It tends to be around our thematical approach that we're taking. So as you probably already know, if you're a client, our first quarter, Q1 of 2020 is really a lot of what we're talking about is estate planning, and we send out packages to everybody to make sure, you have your beneficiaries done, you have your trusted contacts designated on your account, and that you have completed your estate documents. You know, 60% of Americans, I think, on a good day have not done any estate planning at all. So as your advocate, our client advocates, we are just, that's one thing that we're trying to facilitate. So there's a little bit of accountability saying you need to get it done, and then we can help shepherd you through the process if you haven't gotten it done. So we're hoping that, you know, doing this every year or every 18 months, we'll get more traction and help people get it done. So educational components will usually mirror that. So Q1 is really estate planning. The end of this month, we're probably going to have a 45-minute to an hour webinar around estate planning, topics. So that'll be a little bit deeper dive. Q2 would be more of tax planning. So if you remember last year, we reviewed everybody's tax returns. We're going to be doing that again. This year, we just decided we're going to do it a little bit earlier. So while you're filing your taxes now and it's top of mind, we're going to encourage you to get a copy to us. We're going to review it. We're going to interface with your CPA and say, you know, clarify any points, and then look at planning for the rest of the year. So you'd be surprised last year, even though that I'm friends and partners with a lot of your CPAs, we found mistakes. And then we found a lot of planning opportunities that the CPAs don't always see, just because they have a little bit different lens than financial planners. So that's where that marriage, the relationship really adds value, we think. So putting that in, I'm seeding that thought now. Let's get your tax returns as soon as you're done, you know, in April or whenever. Upload it to your vault, which I'll show here shortly if you don't know where that is. And then we'll probably have a tax planning more on the advanced side, probably sometime in April. So that's kind of the format this year. We're trying it out. If anybody has feedback or ideas, or you say, hey, Todd, this is a crummy idea, just let us know. So today is open forum. So questions, we had it actually yesterday rather than Tuesday, and we had a pretty good discussion. I can review some of those. I have some questions that were sent to me via email that I can go over as well. But to open it up, did anybody have anything they want to share or any pressing questions at all? And I do want to remind everybody, I forgot to mention this. I am recording these sessions. So if you're worried about confidentiality, privacy, anything of that nature, obviously, if it's something really germane to your specific situation, let's talk offline. But just be aware that these are recorded for your future use, as well as anybody that's missed it that can't dial in. So I just wanted to bring that up. So, well, let's go to questions. Let's see if anybody, there is a chat feature too, if you hover on the top right. So if you prefer not to speak and you want to enter a question, feel free to do so in the chat feature. I will be checking that periodically. But let me go to my emails and see what questions we had come in this week. I think one thing that Frank and I were talking about, maybe Frank can kick us off here. This is more of a common kind of question than you think. but people always ask about gifts and how do gifts work and are they taxable and to whom are they taxable? Frank, I think you're on here. Do you want to talk to that a little bit?
Good.
Maybe he doesn't want to. So, so the key about gifts, anytime you gift property or cash to somebody, there's no taxable event for those who receive. Let me close this here. Anybody who receives a gift, there's no taxable consequences for receiving a gift. So you can give your child or family member or friend as much as you want without them incurring a tax. The issue when there's a tax consideration is for the grantor, the person giving the gift. If it's under what, 15,000 per year, there's no gift tax. There's no gift tax filing. It's when you exceed 15,000 that two things come into play. One is you have to file a tax return notifying the IRS that you gave that gift. And two, it may be a taxable event. So you may not be planning to do this now, but in the future you might, so you need to be aware of that. But it could also, you can actually create a gift on accident. You could make somebody joint title to your property or your home or checking account, which could trigger a gift. Because say I have 100,000 in a bank account and I put somebody on as joint owner, I'm essentially giving them half of that asset. So that could trigger a gift, which would then incur me filing or having my CPA file a gift tax return. And then depending on where we are with the estate tax rules, there could be a taxable issue. As it stands right now, when you make a gift, even if it exceeds 15,000, it's probably not going to be taxable. And the reason for that is that everybody gets a lifetime exclusion or a lifetime credit of, what is it, 11.5 million now? So that is for your estate, but it's also for gifts that you've made during life. So if you never use up that $11.5 million credit, then any gifts you give throughout your life will never be taxable. And I think that's what people are confused by. When can I give a gift? What's the tax ramification going to be? Do I have to file a return? So the answer, I guess, to synthesize that is no tax to anybody, the recipient of a gift. Anything over 15,000, you have to file a gift tax return. And then really there's probably not going to be a gift tax unless you have a large estate, or depending on the legislation and new administrations, if they change the estate law, you're probably never going to pay a tax on that because you'll never use up your lifetime exclusion amount. So, does anybody have questions about that?
Nope.
No? Okay. So I have a question in the chat box. When will you change your mind on BTC and maybe start incorporating some into the portfolio? It's a good question. So Bitcoin is BTC. So people love talking about Bitcoin and asking about Bitcoin, and especially when you look at the valuation of Bitcoin over the last couple of years. I still think it's a dangerous play. I think from a risk reward standpoint, it's not something that I plan on incorporating in a portfolio anytime in the near future. So this is Rod. Rod, I can't say when. I'll never say never, but I don't see it happening in the near future. It's an unregulated asset class. That's the appeal. But I just don't see the U.S. dollar allowing Bitcoin and cryptos to take a larger share of the overall money supply. So I guess when that changes, when there is maybe some regulations and when we have more proven metrics in terms of risk versus reward, only then will we start considering putting it in portfolio. So I've mentioned this in the past, obviously we rely on our own experiences, and I think just between Frank and I, we have combined 50 years experience or more. Not to date you, Frank, but yeah, we've been doing this a long time, but we also rely on the biggest money managers in the world. So you could argue that maybe some of these money managers and large banks have their incentives not to want to use Bitcoin. But the way I look at it, the companies we work with probably have 100 different analysts that are the sharpest analysts in the world. And until they feel comfortable doing that, we're probably not going to. So it's a combination of what we think here internally, and a combination of what we know is going on in the industry and what we think the thought leadership is doing. So, it's the same thing with Gamestop. I don't know if I have somebody on here that has Gamestop, but Gamestop is similar. I have a friend and his son did very well on Gamestop. It was by accident. And I think he sold most of it, but then he made a bunch of money again this week. So it's, on the one hand, you feel like you're missing out on a potential upside or even a diversifier, but there's a lot of risks. GameStop and other things just become more like gambling in my mind than true investing. And I know you're probably all bored of hearing this, but the process we take is a little bit more prudent. It's academically based. It's been tried and proven since the early 1950s. It's what big institutions use, and when we're managing people's serious money, we're looking at the best risk-adjusted return with the knowledge we have. So Bitcoin, maybe it's a slice of a portfolio in the future. I just don't know when, and it's probably not on anything, anything that's going to happen quickly. We're always looking at asset classes. I think, Rodney, you might have been here for one of the presentations recently. We talked about, we have our own due diligence in terms of companies we work with or the analysts that we rely on. But the portfolio construction process that we go through and our partners go through synthesize something like 250 different type of asset classes that could be included in a portfolio. And a lot of it's math, and a lot of it is really understanding the risk versus reward matrix, and then also how do those individual components work with each other to create a cohesive portfolio. So there's a lot that goes on to constructing the portfolios that's math-based and history-based, and Bitcoin is just not part of that yet. So I wish it were in some ways, but it still scares me because I think there's a lot yet to learn about it. So Frank, there you are. Did you make it in okay? Can you hear me? So does anybody else have any thoughts? Jamie, I know you've had thoughts on Bitcoin. Anybody else have thoughts on Bitcoin that want to share? Or I think Rodney's looking maybe for input other than mine. Anybody have any thoughts? Frank, what do you think of Bitcoin? I guess he can't hear me. I don't know what's going on. Can everybody else hear me okay?
Yeah, I can hear you. Yep.
Yeah. So Frank, your mic is off, but you can't hear me. Okay. So Rod, I'm not changing my answer. That's going to be my answer for a while. I know you're probably looking for maybe a little bit more. I did ask our analyst that gave the presentation last month. I think you were there too. He didn't do a deep dive on Bitcoin, but he shared the general sentiment of mine. It's not something he's including in any of their portfolios either in the near future for sure. I'll dig up some literature and send it your way, Rod, and we can talk more about it. So, do you mind sharing your personal experience, Rod? I know maybe you have a family member that's doing quite well. Is that most of your interest, or is there other interests? maybe he can't hear me either. Maybe that's why he's chatting. So, okay. So let's move on from that. So I often am questioned about RMDs and QCDs. Does anybody know what those two things are? So Bill knows what they are. Ken, you probably know what they are. The laws have changed. So it used to be if you had any qualified accounts, IRAs, 401ks, you were required to start taking distributions from the accounts. It used to be at 70.5. So Ginny, you got a ways to go until this is an issue for you. So I always joke that it's the IRS's nice way of saying, hey, we want you to spend your money before you pass so we can get our revenue, right? So they basically take the balance of your tax deferred accounts on 12/31 or December 31st of the previous year, and then they use a divisor based on actuarial tables to determine how much that is. So it was always April 1st of the following year in which you turn, following the year in which you turn 70.5. It's the IRS, so they like to complicate it, right? They changed the rule, it's now 72. So you don't actually have to start taking distributions until the age of 72. The caveat being if you inherit an IRA, which some of you have, you actually have to start taking distributions right away. You can't wait until you're 72 to do so. The calculation is very similar. The concept is similar, but they want you to start spending that beneficiary IRA as soon as you can, rather than waiting and deferring it even longer. A QCD is a strategy that I introduce to everybody, and probably have to most of you every year, is what's called a qualified charitable distribution. So if you're charitably inclined, or even if you're not, and you tend to give or want to give, you're probably writing a check to your charity, or you have it coming out of your bank account or whatever. A qualified charitable distribution is a strategy where you take the required minimum distribution and you send it directly to the charity. And so the question is, well, why would you do that? And you would do that because, as you know, if you take money out of your IRA or your 401k, that's all going to be taxable. So that's just additional income. So if you're receiving Social Security and you're fortunate enough to have a pension, and maybe you have some portfolio income, those things start creeping higher and higher every year. Tax rates are probably going to go higher, and then it can affect your Social Security and your Medicare. So it turns into this kind of conundrum that more income isn't always a good thing, right? A lot of retirees that I work with, you would think more income would be better, maybe in your working years, but in retirement it becomes problematic because you end up just paying more tax. So a way to mitigate those required minimum distributions is to pay it directly to a charity. If it's paid directly to the charity, then you don't pay any taxes on that distribution at all. So a quick example would be if your required minimum distribution for 2021 is $25,000, you could pay that directly to your charity of choice or several charities of choice. That $25,000 does not show up on your tax return at all. When you say, well, I don't have that $25,000, I want to use that $25,000. Well, for those of you who are already contributing in charity, you're just turning off any contributions you're doing elsewhere and just using that money. So hopefully, from a cash flow standpoint, there's that offset. Does that make sense? Yeah. So that's one strategy that people are surprisingly not that aware of. But I think it's something worth discussing. In yesterday's session, we talked about Roth conversions and positioning assets. So people who aren't quite ready or quite to the age of having to take RMDs, I still think there's time to possibly shift your assets so that you can avoid the large RMD scenario. So if you followed the wise advice over the years and you deduct and you defer into your 401ks over the course of your working career, you probably have a nice size asset, but it's all going to be taxed at some future date. And those RMDs that we just talked about, the required minimum distributions, can be significant, thus affecting everything else from a tax standpoint. So prior to that point, you want to really start looking at what buckets of money do I have and are they positioned correctly? So what does that mean? So if you have a 401k, that's all going to be taxable. If you have a just a regular investment account that's either jointly held or individually held, that's pretty much all been taxed. So it's much more tax efficient when you're drawing from it. So if most of your money is in that tax deferred bucket, you want to try to get it out of there before you're forced to. So if you can reposition assets by taking distributions now, rather than in some future date, it might be in your best interest. So we would certainly run the numbers, work with your CPA and say, hey, if we were to convert some of this to after tax, essentially, what does that do with our tax today, and how might that be beneficial? The other, I think, Ken, you and I have talked about this. A lot of us have talked about this, but with the government spending and other factors, especially that we're at historically low rates, tax rates are probably going to be higher, right? So given that, if you believe tax rates are going to be higher, significantly higher in the future, then taking the distributions now rather than 5 years from now might be beneficial too. So it all kind of ties together. But if you can minimize your RMDs with a QCD, that's one strategy. If you can do a Roth conversion, that's another strategy. And sometimes it's not any one strategy is significant by itself, but you start cobbling these things together, they can have a real impact. I think the misconception, I taught a class on this last year a little bit, but the misconception is really two things. One, I'm going to be earning less in retirement, therefore taxes aren't going to be an issue. And that's not true. I can see who's on this call today. I know they've run into some tax issues in retirement that they didn't think was going to happen. And two, that a lot of people don't even know your Social Security could be taxed. So that turns into this cycle where if your Social Security is taxed, up to 85% of your Social Security could be taxed. People are relying on that income to complement other things, but it's going to be taxed. That means it's lowering your cash flow. So what do you have to do to make up for that? You have to go back into your IRAs or your portfolios, take more money out to make up that gap. Therefore, there's more income taxes, right? So it's kind of this cyclical problem. And I always say this, others have heard me say this, that those who have Social Security taxed versus those who don't end up depleting their funds much faster. So the investment piece in all this is important. But what we look at and why it's important that we look at your tax returns and why we're trying to be much more proactive on the tax planning side is try to make sure things are structured more optimally so that you're maximizing what we call your keep, right? Is how much you're keeping. So we can keep your fees and your investment costs as low as possible while still keeping my lights on. If we can minimize your taxes as much as possible, we have positioned your assets appropriately. Therefore, your Social Security becomes less taxed. You're now getting hopefully multiple streams that are tax efficient, some of which will be tax free. That's just going to increase your lifestyle, your ability to make your money last, and increase your income. I mean, that's what it's all about, right? So, questions? I just spouted off a whole lot.
I have a question.
Sure.
To convert IRAs to the Roths, that's a significant hit for probably everybody on here, and that's a lot of cash. Do you recommend maybe using other accounts to pay off those taxes that are currently invested? Or do you think that you should have the cash to pay that tax ahead of time before you would do that?
That's a great question. So the first part of that, it doesn't necessarily have to be a big hit, Ken. So I just want to remind everybody, if you do a Roth conversion or you consider that strategy, you can do it piecemeal. So it's certainly, you're not going to take it and do it all in 1 year. You could certainly do that, and I've discussed that with people, but I think that's unwise. So we generally prefer, and you and I have talked about this, bumping the bracket if we can. So we're just converting enough each year to keep you in your current tax bracket. So you're stretching that conversion over a number of years, therefore lessening that tax bite. So that's number one. Number two, sometimes there's other strategies that we can do to offset that that tax bite, as you call it, or hit. So there's a lot of charitable type strategies out there, for instance, that you can structure that mitigate that other income. So you could couple the conversion with something else to make that tax go away, or at least minimize it. So keep that in mind. You just have to be willing to take the time and increase complexity a little bit to do that. If you're not interested in that, then yeah, you're going to take a tax hit. It's just a matter of how quickly you want that tax hit. I do recommend that you have it set aside, some combination of, the cash, I would say cash number one, and then an investment portfolio number two. Is that what you're getting at? Yeah. Setting it aside, I think makes sense. I think with any portfolio, you want to keep it intact as long as you can, just because the opportunity cost. But it's all situational, I know some people just like to have a significant amount of cash on hand that might, in my estimation, might be too much. But it makes us comfortable, right? So it's always balancing the two, what's too much, what makes us comfortable. So I think having it set aside ahead of time makes sense. Yeah.
That's the better way.
I think so.
Yeah.
What is your thought? Do you have a particular thought on that?
No, I think that's the most ideal. That it's for me, it's more for my people are going to inherit, and doing it for them and giving it time to grow.
Mm-hmm.
I don't know. It's a difficult thing to look at, especially over time with the stock market so high. You're still going to pay the tax, but then if it drops after you convert to a Roth, well, then you're trying to make up lost ground. So
yeah,
I guess in my mind, wait till the market goes way down, then maybe really get serious. I don't know. I'm not sure I'm right.
I don't think there's a right answer, and yeah, who knows? You could be waiting a long time. Yeah, but I think you bring up a good point. You used to be able to do a do-over, so if you converted to a Roth, you could pull it back for those situations, but they don't allow you to do that anymore. So it does get a little bit trickier in terms of market valuation, So one thing to consider about that is, I remind everybody of this, you're not all in the stock market, right? So typically when you're in your 60s and 70s, you only have maybe 50% of your assets in the stock market. So that, what you're talking about, a big drop in the market, shouldn't have a huge impact on your portfolio, number one. So that lessens what you're talking about a little bit. Number two, nobody said, there's no reason you can't convert non-equity positions, so you could convert any asset you wanted to. You could convert cash, or you could convert bonds. So that issue becomes less relevant. You know what I mean? It's just I think the key that you and I have talked about is what is your incentive to get the money into Roth type accounts? And I think you hit one of the pertinent issues is it's for the kids. You're prepaying the tax essentially now for somebody that's eventually going to inherit it. Okay. So let me back up, if I may, and explain that to other people that may not understand that. So when somebody inherits an IRA under the current law, they're required to start taking minimum distributions that we talked about. It used to be that they could stretch those distributions over the course of their lifetime, right? So they would use the actuarial tables that we talked about. So say your 40-year-old child inherits your IRA. Well, they used to be able to do what's called a stretch IRA. They could say, okay, based on being a 40-year-old female, I'm going to live to 87 and a half. So here's my divisor. This is how much I'm required to take out every year for the rest of my life. They were able to do that. The benefit of that, instead of just taking the money, is that A, they're not squandering it, which may or may not be an issue for some people. So they're getting a little bit of money at a time. And B, really, is it's stretching out the potential income tax situation to that heir, right? So if you think about the average, a lot of 40-year-olds are kind of at their almost their peak earning years. They're probably in a decent tax bracket in their own right. So then if they inherit an IRA and they're forced to take money out, that's all going to be tapped, put on top of their other income. So your hard-earned money and savings that you've now passed along is actually being eroded by that tax. So they used to be able to stretch it out over the life expectancy, but recently that law changed and now they're required to spend it in a 10-year period. So there is a much more condensed period of time where they have to drain essentially your IRA or your 401k. So from a legacy planning and a wealth preservation kind of standpoint, that's not that efficient. If you were to move your money into a Roth IRA prior to that, you do have to pay the tax now to make that conversion. But then when your heirs were to inherit the Roth IRA, they're not faced with any taxes on that at that point. So the conversion is certainly for you, pay the tax now, convert it to after tax, take distributions maybe at a, that are going to be tax free later. If you're around long enough and you need to do that. But it's probably in a lot of cases for people on this call more going to be for your heirs who inherit it. So Ken, I don't think you mind me saying, your decision is really, you kind of said it yourself, is, do I want to prepay the tax for my kids? And do I want to make inheriting the assets easier for one of those accounts? You know what I mean? It's not so much what the market's doing and do I want to convert it for my own income? And I think that's the common crux of the decision for most people. Does that make sense, everybody?
With an inherited Roth, they don't have to take it out until they're ready, correct? Is that
Correct.
true?
Right.
Okay, no 10-year requirement.
Correct. Yeah. So yeah, so that's, so when we're looking at tax returns, we're looking, how are your assets structured? A lot of you I've worked with for 7, 8, 10 years, so I know how they're structured, or I was part of structuring them. A lot of times I'm coming into the back end and people have been investors for 20, 25 years before meeting me. So it's like, okay, can we do anything now to mitigate what I foresee as potentially happening down the future? So we're looking at that when we look at your tax returns. And I just want to throw out there, Ken's son is a CPA friend of mine. So, and everybody else I think on here works with other CPA friends of mine. The CPAs do a good job, but you got to remember a lot of the traditional accountants out there are really faced with compliance. They want to just make sure that they're very accurate in reporting what happened last year. And that's what you pay them for. You're really paying for them to do the compliance piece, saying this is what happened. Like right now, they're all, head down, making sure that they're reporting what happened in 2020 is correct and accurate. But there's very little planning on that. It's really reactive, right? It's reactive compliance work. That type of volume business and the deadline-driven business that they're just subject to working with the IRS doesn't always lend itself to be forward-looking and proactive from a planning standpoint. So it's not that one is better than the other necessarily. You just have to understand that where they're operating from and who you're working with. The CPAs I work with are typically very proactive, but we do that kind of in concert together. So anytime you share a tax return with me, I'm talking with your CPA, and we're looking at these strategies of saying, all right, is this the year to consider something or not? Or, what can we do to minimize tax? Or, what is going to make your outcome more optimal long term? So that was my little plug for my CPA friends. I don't want you to think that I'm stepping on any toes there. So no talking to Luke after this, Ken. So good. Did I answer that, Ken, or is there?
Yep, no, that's what I wanted.
Did I explain that, Jenny Laird? I know, not to put you on the spot, but I know that sometimes I speak quickly, so I want to make sure. Thanks, Bill.
No, we got it.
Okay.
Thanks. Do you have any questions, Laird?
Well, I'm not really sure, but if you take that IRA, can you add somebody else's name to it so that you wouldn't necessarily, like in my case where I have to take my draw, if I could add Jin's name to it, would I still have to take the draw?
Unfortunately, you cannot add somebody else's name. You can't have a jointly owned retirement account.
Yeah, figures. Okay. Yeah, no, I was just trying to beat the law there, but
Hey, that's kind of what I do for a living. And no, I get it. I'm open to creative ideas, and I don't know that I have them all. So
That's a good question.
I do a fair amount of studying of how to, essentially skirt the laws.
Okay.
Not break the law. I want to be clear, not break the law.
Break.
Yeah, we don't want to break the law. We just want to make the law.
Well, that brings up an interesting point when you talk about, when Rodney and his tax return and Trump and his tax return, how little tax some of these folks pay. It begs the question: is there an ethical dilemma there, or are they okay doing that? And it's a personal answer really, but I tend to lead that if the law is written such a way and you follow the law and you happen to mitigate your tax situation, you're in your right to do that, and
You're always able to pay more taxes than are due. You're handed out to do that, but there's nothing unethical about paying only the tax you owe.
right. Yeah, I haven't heard too many people that felt bad for paying less tax, but I got 20 more years maybe in me in this business. Maybe I'll run into that. But for the most part, people are happy paying less tax and they feel like they pay their fair share. Anything we do is not abusing the law. We do some advanced tax planning stuff. It's just using it to your advantage, and and to me, it's fun. I enjoy it because, it's studying finding the loopholes, finding the opportunities that maybe you're not aware of, so.
Todd, I was just going to say, that was a helpful discussion. I know we've talked about it before, but it's always good to kind of re-educate ourselves on that. So thanks for sharing that.
Sure. Thank you, Bill. Yeah, I do repeat myself. I have the case of the repeats, but I think for some people it's helpful. So, so good. I'm glad you got that.
Consistency in message is a test, so you're doing well. The message changes, that just makes people uneasy.
Yeah, I wonder that. I'm glad you bring that up, Bill. I'll pose that. I mean, I kind of alluded to that with the question about Bitcoin, that I sound like a broken record in terms of, or at least in our investment philosophy, but it's true, I think, across the board that I don't change radically. And for those of you who've been with me a long time, it's kind of the same old, same old. So does that give you peace of mind for a lot of you? Yeah, Bill? Yeah. I know that I try to bring new strategies and new ideas and help synthesize information that's out there because there's a lot of information. Just doesn't mean it's good information, right? So we try to be your filter for that. We want you to come to us and say, hey, we heard this, or we read this, or so-and-so was talking about this on the radio. What are your thoughts? Because, the majority of it's not really good information, number one, or number two, it's just not germane to your situation. So it becomes irrelevant. So, but yeah, I joke, I'm boring. It's the same thing that I've been saying for a long time. But if it works, I don't see a reason to change. So, how's your wine, Jenny? You having a little wine?
It's a happy hour. Am I the only one
I have coffee. Hey, you're the only one. How do you feel about that? I'm just kidding.
I feel fine.
Well, Frank was at the office and he said he was going home to have a beer, so he's just not on camera. So
He's just not showing, yeah.
Mm.
And he can't hear us teasing him.
he's having computer issues. When he had the same issue yesterday, our coffee yesterday morning. So I'm not sure. But I joked, there's no drinking on corporate grounds, so I'm having coffee. So
You should do this from home sometime.
I may. We'll see. I'm not always going to be in town or, in the office when this happens. So my hope is I'm dialing in from somewhere fun one of these months, so to make it interesting.
Palm trees in the background.
Yeah, I was going to go to Florida next week, but I decided, Jamie, I was going to go to Florida, not by you. I was going to go to Fort Myers area. But I decided San Diego is closer and easier and more reasonable and less likely to have the spring break issues. I don't really want to go somewhere with, the college kids and the stuff that they're doing, so.
They're icky.
Yeah, San Diego will be fine. It's in the 70s, but it's not like Key West or something. So. So we're almost at the top of the hour. Anybody have any other questions or
I have one other question that I really wanted to ask. When you talk about, the taxes and the different loopholes and all of that, when all the CPAs and everybody keeps going through all these loopholes, and then the IRS finally catches on, how often do they close all those things and then there's lesser and lesser of them? Does it happen frequently? I'll give you an example. When I was in college, I was working tuition remission, and it was great for a while. And then all of a sudden the IRS caught up with that and there was no more tuition remission. So because we weren't paying taxes on that money. So that loophole was closed. And I don't know if they've ever opened that up, but do they close them faster than there are new loopholes? Do you know?
That's a great question. And I'm not going to stand here and pretend that I have all the answers. Every new legislation that comes out, there's always planning opportunities.
Yeah.
In my experience, and I'm not a CPA, right? But, and maybe one of our accountant friends could speak to this more because they see data that I don't. But in my experience, there's more opportunities than they close. I think as soon as new legislation comes out, it might close one, but then it opens up a host of other opportunities that they didn't even think about. So, and there's a lot of people like me that love to do that and dig in and say, oh boy, what are we going to find here? And the whole accountancy, profession, there's always going to be opportunities. The IRS is, a lot of the laws are politically driven, and it's just layers and layers of old laws with new laws layered on top. It's a mess. I don't see them closing them that quickly. But when we look at certain strategies, we're like, what is the legislative risk? How has something like this been treated in the past? There's some advanced strategies that get on the Irs Dirty List, for instance. I know one specifically, one or two last year, that has gotten a lot of scrutiny. But that's usually when people are abusing the system, would they be more likely to try to regulate or close that? So conservation easement, for instance, was one of the dirty situations. Ken's laughing, he knows of that. Some captive insurance agencies, which is a strategy that we recommend for business owners. That's been under scrutiny. They haven't gone to the extent with easements with captives, but they've disallowed the deductions, only waiting for litigation and appeal. So we see more of that where things are disallowed, but it's really the abuse. where it gets on the IRS's radar. Stuff that we're talking about is probably less likely to be on the radar because there's not an abuse happening, you know.
Right. Okay.
And then the IRS also, we always talk about this. There's only so much the IRS can track. And I think it's impossible for them to track a lot of these different competing strategies that are happening. And then and before they close something or before they're even going to audit somebody, everybody's just scared of being audited. You got to remember, before they're going to send an agent to do anything, there has to be significant ROI for them to even spend the time, you know. So your typical taxpayer, even if they get audited, isn't going to get a lot of time spent unless there's some payoff for the IRS, right? So there's bigger fish to fry. But it's the same thing with closing loopholes. Like, let me give you an example. And this is more opinion based, but people ask about, you know, will the laws for Roth IRAs change in the future? So they're like, because Roth IRAs, as we've been talking about, there's going to be all tax-free distributions in the future. So that you could have a Roth IRA for 20, 30 years. All the income and growth inside of it has never been taxed. And when it comes out, you don't pay tax. So a lot of people commonly say, well, do you think a Roth IRA, the laws are going to change? So that could be a loophole, Laird, in a way.
Right.
But just as an example, as it stands now, the lion's share of the money, if you were to look in aggregate where are assets mostly held, most assets are still significantly more in the tax deferred bucket than the Roth bucket. So my contention, based on this logic that we're kind of talking about, is that if the IRS is going to change something, it probably won't be the Roth. It would probably be where most of the money is, because they get more ROI to do that. There's more immediate impact. So the Roths have really only been around since '97, and it's grown in popularity, and that's adding up. And maybe it'll change when there's more assets in that particular bucket. But my thought process is, unless, you know, they're going to focus their time on the big wins rather than other things. So
Yeah. Okay.
yeah. Ken, you and I may have talked about that. Did you even pose that question to me one time, maybe, about the Roth changing, the Roth laws changing?
Yeah, I bug you all the time.
Well, I probably gave you the same answer. There I go again, giving the same answer.
But it's good to hear it again. I'm good with it.
I got to come up with, all right, I got a month. I'm going to come up with new material for next time. So you got
You have to wear a different outfit.
That's right. This is just a recording. Did you know that? So it's fascinating. I am looking. I have a partner firm that I work with, and actually I introduced this concept to Luke. He runs a robotics firm, and so I watched his presentation. I met him, and I'm even considering, you know, looking into it a little bit more. The way he explained artificial intelligence and his robotics business is AI is not the scary kind of sci-fi stuff that we think about. Robots are going to take over, but essentially you can create a robot or a bot to do anything that a human does on a computer. And so maybe not this, but you've probably experienced and not even known that when you call numbers, right? Do you know that robots are usually answering it, but they sound just like people? So if you order a pizza or you any service industry where you think you're calling somebody, a lot of times it's robots. And so he creates these bots, and he's created in such a way that there's a really low entry point. So you could go to him and say, yeah, I'd like a bot to do my data entry every month. Okay, that'll cost you $100 a month. And now you have a bot that will do that. And they call it floors. Like it's fascinating to me. Sorry if I'm getting off point here, but it's fascinating to me because he's doing it for insurance companies, like big insurance companies. And he says, yeah, we'll have a whole floor in this virtual robot world, or whatever you want to call it, that's all bots working for that insurance company. And they all have different tasks. and they're all doing things, and they're all working 24 hours a day, 365 days out of the year. So I just find it fascinating. So I might have a bot running this, I guess is my point, but I doubt it.
We're
Won't
all on,
be really as much fun as you.
everybody on this call is old enough to remember Max Headroom.
Yeah. 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 But it's interesting, you know, world is changing, you know, from an investment standpoint, I think there's a lot of opportunity in the AI, the tech, you know, tech has been leading the way for a while. I think it's getting overvalued right now, but you know, those looking for those type of investments, it's high risk, but it's changing the way we work and we live. And I think COVID is only going to accelerate that, you know, probably even more. So,
Yeah.
So. Who's got other questions? Anybody? Let me, we're getting close to the hour here. I want to be respectful of your time. Like I said, I'm not going to force this and just to talk. Let's see if there's any other questions that came in. I also wanted to show everybody the vault real quickly in case you don't remember where that is. Anybody have any thoughts or questions? No? Okay.
Can I add something?
What's that? Yeah, go ahead. Yeah, I didn't know you were
I
get in.
I-
What?
I got my video and audio working finally. Something that Ken had asked about an inherited Roth IRA, and the question was the 10-year rule for a traditional IRA and the advantages of converting. If I thought I heard him say that, and I thought I heard you confirm, Todd, that the 10-year rule didn't apply to Roth. It does apply to Roth, but there's just no taxes due.
Well, that's all we really care about.
Yeah, yeah. But you do have to take the money out. You can't leave it in there forever.
Right, but it's not. It doesn't add to the kid's tax. Correct. Right.
Exactly.
So thanks for clarifying that. Yeah, I don't think. I think I may have not explained that correctly, but right. Yep. Thank you. Well, better late than never. You made it in, so good. Thank you. Thank you for that. I was just.
What I did wrong. Stay off the web. Use the installed software.
Yeah. You've had computer issues the last 2 days, so. So how many here are using the personal financial website that we give you? Anybody? Nope.
We have stuff in there, but I haven't revisited it in a while. I need to do that.
Okay. I was just going to show that real quickly before we go. So our goal with the personal financial website, I invested a fair amount of money in it just because for several reasons. One, I think it adds simplicity and value to you organizing your financial lives. So I think people that use it, if they want to, I know everybody kind of has their own money management system, but people that want to use it and can use it, I think it can add a lot of value of consolidating everything in one place. You can use it for yourself. If you have an heir or trusted contact, they can log in and everything could be there if you use it to its full potential. It's safe. It uses the same encryption that a bank does. So I'm sensitive to maintaining your data. Even if somebody were to be able to get in there, it's just scraping data from other sources, so there's no way to take action. So it's safe. But the reason I offer it is for that simplicity and consolidation primarily, but secondarily, in an effort for us to be proactive and continually doing planning activities for you, the better data we have, the better we can do that, right? And in the old days, and a lot of you have gone through this with me, we say, okay, we want to do this type of plan, whether it's a retirement plan, cash flow plan, whatever. Let's start the data down. Bring me all your statements and your social security statements and all that. Then we'll do an analysis and then I'll crank out a plan for you and we're done. The problem with that is now it's already dated by the time we're finished with that process. So using an interface like the personal financial website, it should be up-to-date data so that we're now creating a plan and projections that are more or less a living document. And there's less of that paper shuffle less of that back and forth. And when you log in, if you're using it, you can see all the important financial data in your whole life all in one place. So that's the backstory of why I integrated into the business. It's not a requirement that you use it in terms of how we will work with you, but it's just a convenience. So this year, I rolled it out a year plus ago, and I've never really proactively mentioned it to a lot of people other than in meetings. This year, I thought, I'm going to make an effort just to make people aware of it. And if they like it, then they can use it. If not, it's free of charge. Obviously, like I said, I paid for it. But I wanted to just point that out real quick. A couple things in closing. Ginny, have you had problems trying to add things? Has it been
No, it's been a
cumbersome?
while. It's
Yeah.
been a while. I can't remember what I uploaded to it. And yeah, I can't remember what I uploaded, but it wasn't difficult.
The fun part is there's only one slot you can add things into, even though there's 47 files on there. Like while we were talking here, you want to see tax returns, so I went to put my tax returns up there, and I went to taxes, and it wouldn't let me put it in the tax folder. It only lets me put it in one folder. So
Yeah, you typically have to put everything in the shared folder, and then we'll put it in the other folders.
Right.
That might be a setting, and they're always changing things on my end too. That might be a setting, Jamie. I'll check on my end if I can change the vault setting so that you can segregate the folders as you see fit. But I think the rationale might be, hey, just put it in a share folder so we can see it, and then we would file it for you. But I'll check on that. And that's kind of what I want. I want some feedback. If it's something you guys don't like or it just doesn't work, I need to know. But let's see. I'll share my screen here in a second. So the way it works typically is, like I said, it's an aggregation tool, and it's a financial planning tool, and it also has the storage capabilities. From the aggregation standpoint, we automatically add any accounts that we manage on your behalf to your personal financial site. So what that means is it's a data feed, a direct data feed from TD Ameritrade into your site. So that's updated every day. So it's live. If you were to go in the personal financial website and add your other accounts, you put in your secure credentials for that particular account. So say it's Ent Credit Union, you would choose Ent, you would put in your login credentials, and then it will have the same type of feed and pull in any accounts or any liabilities you may have with that particular institution. So that aggregation that I was telling you about before, that's part of the security, is that we're only scraping data, but they can't get into your end. If anybody were to get into your site, there's really no way. Jamie's an internal auditor by trade, so he'll say otherwise, but they really can't get into from this interface into like Ent or whatever institution. But if you add in all your accounts that you may have, then when you log in, you will see an updated version of that. And to us as financial planners, Frank and I were talking about this a couple times this year, is everybody really should have an accurate balance sheet and an accurate income statement. So my kind of goal this year is to make sure all my clients have that at the minimum. So a balance sheet is really an accounting of your assets and your liabilities, arrive at your net worth. And then your income statement is what is your cash flow? How much is going out the door essentially every month and year. So if you attach your accounts here, or you enter them manually, that'll take care of your balance sheet. If you attach your accounts, say you spend, let's just say hypothetically, I know some of you most of your spending goes through a credit card. if that's the case and you put your credit card in here, there's a cash flow module that will then categorize all your spending for you automatically. And there's some nuances. You have to go in there and clean it up because it will say, Exxon was a restaurant or something. So you go in there at first and you clean that up and you say, no, this is mischaracterized. And then it's smart enough. It's not quite a robot, but it's smart enough to remember that next month. And so the heavy lifting is at the beginning to get it set up, but in future months, it should remember how to appropriately categorize your spending. So that covers your income statement, because then you have an idea of where's my money going, what percentage of this spending anywhere. That helps us when we collaborate with you, because now we have a snapshot of everything. You have assets, some of you have assets elsewhere that we're still going to help you with. It may not be with TD. So we can be much more comprehensive and holistic from our advice offering. But then some of you are, in the retirement or just getting a retirement, how much can I spend, or how much do I need to spend, or knowing what your current expenditures are, help us kind of extrapolate into the future. So that was a long-winded explanation, but that's why we're doing it, and that's my goal. And but it does take a little time to set it up at the front. And if you are interested in doing it, but you're like, Todd, this is difficult, or I don't want to spend the time, we'll set up an hour and we'll help you get set up. Either Frank or me or Tracy or some kind of combination. We'll spend an hour with you getting it set up, because I think it's worthwhile. So I'm going to just share my screen here finally. And show this to you and point out a few things. And you should be able to see Katie and Tim Stevens here. They're not real people. They're robots. Everybody's robots. I'm going to be playing on that for a while. So we have a different view. We have a different interface. So when we log into your account, it looks quite a bit different, but it shares data. When we update things in here, it'll be reflected in what you see and vice versa. So just across the top, if you look real quickly, it's home, organizer, spending, investments, vault, and reports. So your home is going to show you that snapshot, your net worth, your investments, how your accounts are broken down. Katie and Tim have this much in cash. This is how much is broken into taxable. This is your tax advantaged. Negative 300,000, that's a mortgage. This is their property value. So if you were to log in, this is the first thing that you would see. You'd see a snapshot of spending. And incidentally, I think it's worth noting the spending part you can hide from us if you want to. You don't have to share everything with us. So you can get a lot of use out of this without necessarily sharing data with us if you don't want to for whatever reason. But spending would show here. So net worth, investment, spending. If you have any insurance, it would show here. So when you log in, we do have a phone or an app if that's convenient for you too. So on your tablet. So if you're at the bank, or if you're with an attorney, or wherever you are, or if you're traveling, you can go to the app and pull up any of this information that you may need. I think that's pretty helpful in the case of the vault for those of us who like to travel. Having a copy of your driver's license or your passport or your state documents could be here. I told the story yesterday. I lost my driver's license in St. Louis a couple months ago. I wish I had followed my own advice. But luckily, they let me on a plane without a driver's license, which never in my life did I think that would ever happen. So that's an example. Something happens. We have a copy. We have access to the copies as well as you. So Jamie was talking about this. When you log in and you share and you put documents, you're really just going to see this. On our interface, we have a number of folders where we would put tax returns, your state documents, and things like that. So back to our theme for the quarter, It's making sure that your estate stuff is really dialed in. Some of you it is, some of you isn't, but at the end of all that, I think it makes sense to even store it here. You know, you're probably going to have it in a safe deposit box. Hopefully your attorney also should have an electronic version, but even it doesn't hurt to also keep things like that in there as well. That does two things. We can review your estate documents for you, just another set of eyes, but then store it as well. Were you going to ask something, Ginny?
No, I was thinking, I didn't realize you could upload all those things to this account. I didn't realize that you could do your credit cards and your passport and your driver's license. I didn't know that. But I was wondering too, are you still using Blue Leaf? Is that something?
Yeah, so that's a great point. I was going to bring that up, and I probably would have forgot. So, you know, my tech budget is very large, and my tech stack is too cumbersome, like a lot of businesses. Well, so I think I counted a couple weeks ago. We have 15 or so different interfaces that we use to run the business. And unfortunately for you folks, it's also got a little cumbersome. When I started working with TD Ameritrade Institutional to safeguard your assets as our custodian, they offer advisorclient.com for online access to accounts. I wasn't particularly happy with what that interface offered clients. It lended itself to be more like a bank account reporting, where you just say, this is what was in it, this is the opening balance, this is the closing balance. And for some, maybe that was enough. But I wanted more for people, so I purchased Blue Leaf as an overlay to that also does the aggregation. So it pulls in the data from TD Ameritrade as well as other outside accounts. And the reason I did that is because I thought it was a little bit more robust reporting and gave more details for clients than you could find on Advisor Client through TD. So that was kind of the first step. And on there, you get reports emailed to you when we have meetings one-on-one. I'm using a lot of the reporting functionality. I'm benchmarking your portfolio returns to a respective benchmark. So when we're looking at percentages of return, for instance, we're not just looking at, okay, you had a decent rate of return. In Blue Leaf, you can see, even when you log in, what did it do compared to the market? And that gives us a better sense of, is it doing what it's supposed to be doing? So that, and then we put our invoices, even though we don't invoice you directly, it comes out of your accounts. For full disclosure, the invoices should be uploaded up in there as well. So we're still using Blue Leaf in that capacity. Okay. This is kind of the third step, and this is why I was kind of apologetic, because there's really 3 ways you could access your information, and it's confusing. To me, this is much better than the Advisor Client with TD, and it's better than Blue Leaf in the sense of all the functionality that it has. However, Blue Leaf still does the performance reporting and the invoicing that this does not. So if you were to pick between Blue Leaf and this, I would say use this. Is superior to all 3. Does that make sense?
Yep.
Okay. So we still use Blue Leaf. You'll still get reporting there, but this is more financial planning. This is really designed to be kind of your financial hub, right?
Okay.
If you want it to be, where everything is here. So back to this, that's the home screen. The organizer, when you go see your accountant, you typically fill out an organizer, right? And so this is similar, except it's a lot broader. So this drives a lot of the planning. So you can add your accounts. So if you went here, this is what I was talking about. You can link accounts. Typically, when you click Add Account, it will ask where's the institution, and then that's when you put in your credentials. But you know, it's kind of sequential. You put in your accounts, any professional contacts you have. So that could be me, your accountant, your attorney, your insurance person. This is your income and expenses. This will pull in if you have your accounts added, but you also can add it manually. We go in and add things manually because we have a lot of your financial planning data already, like your future goals, like we're retiring in 2021. We want to spend $15,000 a year in travel. We'll put that in there. We think we're going to buy a car in 2025. We'll put that in there. So your organizer really drives everything. So for people that are interested and plan on using this, we'll probably be saying, hey, we're going to be meeting soon. Before we meet, why don't you go in your organizer and make sure it's up to date as much as possible. Or we go through it together when we meet. But that's really what this is. Don't worry about risk tolerance. We do that for you. Financial priorities you probably know, but you can go in here and add and remove. You know, what's important to you. There's the spending module that I told you about. Not available for me right now. You can look at your investments. So this is similar to the Blue Leaf, Jenny.
Yeah.
It just doesn't give you a rate of return,
Okay.
but it will give you kind of the history. It'll be skewed because if you're taking distributions, it's going to look like your value has gone down when it only has because you took money out, not because of the investments. So that's why I wanted Blue Leaf, because it shows you, it adjusts for the cash flow and still gives you a rate of return. You can pretty much see the same thing, your allocation, how are we breaking out your particular account, you know, in what categories. So there's a lot of stuff you get here on your investments, probably too much for some people. And then your vault. And then there's some really neat reporting for people that really like this sort of thing. Here's your balance sheet. So I said everybody should have a balance sheet. That's accurate. You can look at your cash flow. You can look at different years, like what is it projected to be. So for the engineer types, this is great. For big picture people, believe it or not, I'm a big picture person more than I am a detail person. For big picture person, it might be too much. So, but I just want to show that to everybody real quick. Any questions? Nope. Okay. I'm going to turn this off if I can.
I was going to say the only difference I saw was on the files at listing, rather than just the share folder, it shows me all the folders. It just won't let me add anything into them.
So it's probably a setting somewhere then, Jamie, it sounds like.
Yeah.
Okay. So I have on my end, I have global settings that would change everybody's vault and individual. I'll just play with that tonight and see if I can get that figured out for you. There we go. There's everybody. So well, I hope I didn't bore you guys to tears. I hope you got something out of this. Like I said, it's pretty much open forum. There's no real format. So thanks for coming. It's good to see you. Did anybody have any other thoughts or questions before we go? No. Okay. So probably
I'd like to put a plug in for the vault to store data or store documents that your children or somebody else can access. My stepdaughter she's been the executor of her natural father's estate. He was living in Illinois. She lives here in Colorado, and it's been a real nightmare for her to find things. And she's 3 states away. So if you have any desire to make life easier for the people that come after you, store it in the vault and give them the password.
Yeah. That's a great point. Yeah, I always use your example, your Doomsday Notebook. Frank, I mean, you can talk to him, but he has a Doomsday Notebook for his wife, where he basically kept, right, you keep everything in it so that like passwords and everything. This is kind of like that, isn't it? You want to speak to that real quick? Or?
Yeah, it's exactly what it is. It's a place to find stuff. I mean, you know, when someone passes away, I mean, there's things like Social Security cards and birth certificates that if you can put your finger on them right away, it makes your life a lot easier if you're the executor.
Yeah. And I was going to also say that for those of you that work with our accountant partners, we give them what's called alliance access. So Luke, for instance, has access to that. So if you tell them to, hey, Todd would like our tax return, they'll upload it into the vault here so that it'll be part of the financial website. That's how we interface safely. So those who work with Samantha, for instance, Vera up there at the front office, she knows exactly how this works. So if a client says, hey, make sure to get Todd a copy of our tax return, she'll upload it to the vault. So we have immediate access, and then we can go into our review process. So just a heads up there. So. All right, everybody. Well, good to see you. Again, end of the month, look for emails on probably estate planning topics. If you have suggestions or anything else that you think would be helpful that we're not covering, we're open. I joked last time, I don't know if you guys were here, that I reached out to the FBI. I wanted the FBI to do something on cybersecurity, but I haven't heard from them. So I joked that they must be still checking me out. I don't know, but anybody, I don't know. I'm kind of a nerd from that. Anytime I hear the FBI, and a lot of people hear FBI, they're like, woo. So I thought people would be interested in that, but so stay tuned.
That'd be really fun.
I'm sure the person would have some good stories, but it's the reality of the world we live in. It's something we have to take seriously. So I probably will, rather than you listening to me all the time, we'll have a speaker like the FBI. Hey, easy, Jenny. I can but I probably will have something on cybersecurity because big data is big business now. It's kind of, even though it's all out there, we have to be careful. And I think we get used to our phones, and people have smart homes, and not that I would recommend that, but it's getting out of hand. So anyway, that's just an example. Have a great night. I will let you go. Good to see everybody.
Cheers.
Thanks, Todd.
See you guys. Talk to you all soon.
Bye. Thanks.
Yep. Thank you.
Bye.
Bye.